Broadcom stock just dropped nearly 12% in a single session on the back of their latest earnings. The market reaction was sharp. The financial media is calling it a warning sign. And in my view, it is one of the more obvious overreactions I have seen in this entire AI cycle. Because buried inside that same Broadcom earnings call was one specific line that I genuinely believe changes the entire conversation about where this market is heading over the next 2 years. A single comment from management that tells you the AI build-out is not slowing down. It is accelerating into 2027 and 2028 in a way Wall Street has not properly priced in yet. Today, I am going to walk you through that comment and then give you 4 specific stocks I believe are best positioned to benefit from exactly what management just told us. Stay with me, because if you have been waiting for a setup to add real AI exposure without chasing something already extended, this is the kind of moment that does not show up very often. A quick note before we get into it: nothing in this video is financial advice. I am not your financial advisor. I am an investor sharing my own research and reasoning. Do your own due diligence, understand your own risk tolerance, and make the decisions that fit your situation. With that out of the way, let us get into it. Let me start with that single comment from Broadcom's earnings call, because everything in today's video flows from it. When asked directly about the AI outlook beyond 2026, management said this, and I want you to really hear it. If you ask about 2027 or 2028, that will continue to grow. We expect, in fact, 2028 to be a substantial growth from what we are forecasting in 2027. Let that sit for a second. We are in the middle of 2026 right now. The largest chip companies on Earth are not just telling us 2027 will keep growing, they are telling us 2028 will be a substantial step up from 2027. That is genuinely extraordinary forward visibility. And Broadcom is not the only company saying it. Nvidia, just weeks earlier, posted record quarterly revenue of $81.6 billion, with data center revenue alone up 92% year over year. And Jensen Huang described the AI build-out as the largest infrastructure expansion in human history. So here's what I take away from all of that. We are not at the end of this cycle. We are not in the late innings. We are in the middle of a multi-year structural build-out where the largest companies in the world keep telling us, in their own words, that demand is accelerating. And when the market hands you a dip on a name connected to that story, the question is not whether to be afraid. It is whether you are paying attention. Today, I want to walk you through 4 stocks that I believe are best positioned to benefit from exactly this setup. The first stock is Broadcom itself, ticker AVGO. Because if the entire premise of today's video is that the market just overreacted to their earnings, the most direct way to express that view is by looking at the company that just sold off. Broadcom is now trading at roughly $418. After the drop, the forward price to earnings ratio sits somewhere in the 27 to 30 range, depending on which earnings number you use. Now think about that valuation in the context of what the business is actually doing. Broadcom Semiconductor Solutions division, which is the real engine of the company right now, grew 52% year over year the previous quarter. The most recent quarter, semiconductor revenue accelerated even further. And on the AI side specifically, Broadcom's AI semiconductor revenue surged 143% year over year in their most recent fiscal quarter, hitting $10.8 billion. That is not a company in trouble. That is a company growing AI revenue at triple-digit rates, toads, while the entire market just decided to mark it down 12%. And here's what gives Broadcom a structural position in this cycle that almost nobody outside the industry fully understands. Every major hyperscaler, Google, Meta, and increasingly others, has decided they need their own custom chips. They cannot rely entirely on Nvidia forever. And when they go to design those custom chips called ASICs, they need a partner with the engineering expertise to bring them to life. Broadcom is that partner for some of the largest names in tech, including Alphabet and Meta. Industry forecasts now project the custom ASIC market growing at a 27% compound annual rate through 2033, faster than the broader AI accelerator chip market. That is the long-term structural tailwind sitting underneath this stock, and the post-earnings dip just made it cheaper to own. The second stock is Nvidia, ticker NVD, currently trading at around $218. And I want to address something directly. I know Nvidia is the most covered, most discussed AI stock on the planet. There are people who hear the name and immediately assume it must be overvalued, that the run must be over, that the easy money has already been made. The numbers do not support any of that. Nvidia just reported the kind of quarter most companies dream about delivering once in their entire existence. Record revenue of $81.6 billion, up 85% year over year. Record data center revenue of $75.2 billion, up 92% year over year. They announced an additional $80 billion in share buyback authorization, and they raised the quarterly dividends, going from $0.01 to $0.25, a 25 times increase. That is not the move of a company that thinks its growth is slowing. That is the move of a company telling shareholders it is so confident in the cash flow ahead that it is now returning capital aggressively while still investing in growth. And here's the part that genuinely surprises people when they look at it properly. Nvidia, despite all of that growth, trades at a forward price to earnings ratio of around 25 for a company growing data center revenue at 92% year over year. That is not a stretched valuation. That is, frankly, a discount relative to what the underlying business is producing. Yes, there are real risks. The cloud giants are designing their own custom chips, which is exactly what helps Broadcom. Pricing power could soften over time as hyperscalers diversify. I take those risks seriously, but Nvidia is still the default platform for AI training. CUDA, their software stack, remains a genuine moat that is years ahead of any competitor. And sovereign AI alone is now a multi-tens of billion revenue line that did not meaningfully exist a few years ago. There are no-brainers in this market, but Nvidia, at this price with these numbers, is about as close as it gets. The third stock is Meta Platforms, ticker Meta, currently sitting at around $627. And this one might be the most overlooked of the four because most investors do not even think of Meta as an AI stock. That perception is increasingly wrong. Meta is now one of the largest spenders on AI infrastructure on Earth, and the payoff is starting to show up in their actual numbers in two specific ways. First, AI is making their existing advertising business dramatically more efficient, better targeting, higher click-through rates, more ad inventory shown to users without degrading the experience. That flows directly into margins. Second, Meta is now openly pushing into what they call agentic business AI, selling AI agents that small and mid-sized businesses can subscribe to on a monthly fee basis. Think about what that means. If you run a small business and you could pay a flat monthly fee for an AI agent that handles customer service, ad management, and content creation inside the ecosystem you are already using, that is a genuinely compelling product. And here's the part of the Meta story that I think is most genuinely mispriced right now. Despite running one of the most ambitious AI strategies in the entire industry, Meta is trading at a forward price to earnings ratio of roughly 19. I want to put that in context. That is one of the cheapest valuations in big tech. Cheaper than Apple, cheaper than Microsoft, cheaper than Nvidia. And this is a company that owns the largest social and messaging ecosystem on Earth, is monetizing that ecosystem more efficiently every quarter, and is now building a business AI product on top of all of it. The risk is the same risk Meta has always carried: heavy capital expenditure and a market that periodically questions whether the spending will ever pay off. But based on what the numbers are already showing, it is paying off. And at this multiple, that is genuinely hard to ignore. The fourth stock is CoreWeave, ticker CRWV, currently around $58. And this is the most polarizing, highest risk, highest asymmetry name on the entire list. so I am going to be completely honest about both sides of it. The bear case on CoreWeave is genuinely real. The company carries significant debt. They have customer concentration. They compete against hyperscalers with effectively infinite balance sheets. Plenty of investors look at the debt profile alone and walk away. I understand that view, but here's what the bears are missing. CoreWeave is right now the largest neo-cloud operator on the planet by operational power. They have over 1 gigawatt of GPUs running and generating revenue today. The next largest neo-cloud, Nebius, has roughly 310 megawatts, less than a third of CoreWeave's operating capacity. There is a reason the debt is what it is. That debt was deployed to build infrastructure that is right now generating real revenue from real customers, not infrastructure that might someday matter. And the backlog figure on this company is, frankly, one of the most extraordinary numbers I have come across in this entire sector. CoreWeave is sitting on roughly $100 billion in remaining performance obligations, contracts already signed and waiting to flow in as revenue over the coming years. $100 billion. Compare that to a market capitalization of just over $25 billion at current prices. That ratio is exceptional. The risk profile here is real. Heavy debt, customer concentration, and competition from massive hyperscalers all create genuine volatility, but the asymmetry is also real. If even a fraction of that backlog converts on schedule and CoreWeave manages its debt sensibly through the cycle, the upside from this price is substantial. This is not a sleep-easy holding. It is a position that deserves sizing, aligned with the risk involved. Within that frame, the setup is one of the more compelling growth stories in the entire AI infrastructure space right now. Let me bring this all together because there is a single thread connecting all four of these names. Broadcom's management just told us, in plain language, that 2027 will be a growth year and 2028 will be a substantial step up from 2027. Nvidia, weeks earlier, told us the AI build-out is the largest infrastructure expansion in human history. These are not retail analysts on Twitter. These are the CEOs of the two most important companies in the entire semiconductor industry, telling us, with their forward visibility, that demand is accelerating, not slowing, and that visibility cascades through everyone else in the supply chain. Broadcom at a 27 to 30 forward PE after a 12% post-earnings dip. Nvidia at a 25 forward PE while growing data center revenue 92%. Meta at 19 forward PE while running one of the most ambitious AI strategies anywhere. And CoreWeave with 1 gigawatt of operational power and $100 billion in signed backlog against a market cap a fraction of that figure. 4 names, 4 different ways to express the same fundamental view that the AI build-out has a multi-year runway ahead of it and that the market periodically hands you better entry points than it should. Broadcom, Nvidia, and Meta are core large cap positions for serious investors. CoreWeave is the high asymmetry, higher risk addition for those who size positions intelligently and understand exactly what they are buying. The next move in this market is not going to wait for the crowd to feel confident again. It is going to happen while most retail investors are still digesting whatever the financial media said about Broadcom this week. If you want to keep getting breakdowns like this on the moments when the market hands you real entry points in the names that matter, hit that subscribe button right now and turn on notifications so you do not miss a single video. And speaking of what is coming, there is one specific AI infrastructure name even further upstream than the 4 we covered today that I believe could be the single most overlooked play in this entire cycle. That deep dive is coming in the next video. Subscribe, and I will see you there.